Hello, everybody. Well, it's the day after Fed Day, and I'm sorry to say that Jerome Powell did not lower the Fed funds rate. That's not really a surprise. We're going to talk about that in a minute, but first, let's get through some real estate market reports that you'll probably be interested in. So first up, we have the Case-Shiller Home Price Index. It was down, it's being reported down month over month by 0.3%, but that is seasonally adjusted. And what they do when they seasonally adjust things, it's basically an averaging. In fact, the raw data shows that month over month, not seasonally adjusted, was up 0.4%. Year over year, it is up 0.23%. And if you look at the 20-city index, it's very much the same story. So not great, not bad, just kind of meh, right? Next up is pending home sales index. So what this is more of a measure of the pace of home sales, and anything below 100 says that we're for sort of 5 million is the number of units you want to sell of existing homes in a year by somebody's decision. I don't know who, but that's what the standard is. And so anything below 100 means that we're not hitting that goal. So it's been somewhere in the 70 to 72 range over the past several months. And it fell 0.6% in the month of June. So employment, that's a big topic of conversation. As you can see, it's been all over the place. It's been up, it's been down. In July, 104,000 jobs were added. And what I think is really interesting here is the breakdown. So small businesses, so 1 to 49 employees, increased 12,000. Medium-sized businesses increased 46,000, and large businesses, those with 500 or more employees, increased 46,000. So that is a good sign of the strength of the economy. Remember, the ADP report is for private sector jobs. So we saw a lot of employment gains, but they were mostly all government in prior years. But now we're seeing gains in the private sector, which is what you want. Okay, the most important measure of inflation, according to the Federal Reserve, Jerome Powell, is the personal consumption expenditures. And this was a pretty middling reading. It came in about where expected, so that's good. The headline number came in at plus 0.3, as did the core reading. The annualized rate for the core, which is what they really look at, the core reading, because that strips out food and energy, which is so volatile, all right? The 3-month reading is 2.6, the 6-month reading is 3.1, and the 12-month reading is 2.8. So there is a trending down, okay? And if you look at the core reading year over year, it was flat. It remained at 2.8%, which is good. So it's not a great report, it's not a bad report, but it is an expected report. So that's a good thing. So that brings us to talking about Jerome Powell. And he made his comments after he announced that they were not going to change the rate, that they were going to keep the rates restrictive. And that, is obviously hurting the country. So I want to show you what the Fed funds rate does in relation to the rate of inflation over the past 25 years, because I believe that history sets an important precedent. You can see that the pink line, which is the Fed funds rate, versus the blue line, which is the rate of inflation, with a few exceptions when they're overcompensating and trying to bring inflation back down. By and large, the Fed funds rate stays at or below the rate of inflation. Now, right here, this is COVID, right here, this big vertical line. And when inflation started to really spike, he was way too slow to act. He waited for 11 months, then he tried to catch up, and he kept going up even as inflation was turning around. And he stayed there until September and October of last year, when he made 2 drops right before the election, and he's held it since. And you can see inflation has dropped significantly, and yet he's holding the same. So all the advisors are telling him that he needs to drop the rates. Everybody that knows anything about the economy knows that his restrictive approach by not lowering the rate, because the Fed funds rate is the source. It's the mother's milk of every other lending in the country. No, the Fed funds rate doesn't immediately impact mortgage rates, but there is a correlation. And so by holding that rate higher, he's keeping the cost of credit cards higher, the cost of auto loans higher, the cost of commercial loans higher. Everything else is being maintained at a higher rate, which is keeping inflation up. The very inflation he's concerned about, he himself is keeping up by not easing the Fed funds rate. but he's going to do what he's going to do. There's a belief that he's going to actually cave and lower the rates some in September. He should probably lower them about 100 basis points or 1%, because right now the Fed funds rate is at 4.5. Inflation, depending on what metric you want to use, somewhere between 2.3 and 2.7. So we should probably be around a 3.5% Fed funds rate at least, maybe a little bit lower, but probably don't want to get there too quickly. You don't want to lower it too much too fast, or that could trigger more inflation. So you have to ease into it, but definitely a reduction is warranted. But he's going to do what he's going to do. The consensus is that September he will be lowering the rates. We'll see. If not, his term is up in May, and we should see some real progress at that time. So another report that came out that was very positive is the gross domestic product report. And it came out for the second quarter, and it came in at 3%, which was way above expectations. It was expected to come in at 2.4, but it came in at 3%. So I want to talk about it because you might think that this is just boring economic stuff and it doesn't matter. But the reason I'm talking about it is because there's a lot of anxiety and fear right now. And by understanding what is going on, you can help assuage a lot of that anxiety and fear if you understand what the facts are and what the data says. And I don't get into the politics of things. A lot of people accuse me of, being political, but I'm not being political. I'm just calling balls and strikes, and the data speaks for itself. And if the data says something, then I'm going to present it. That doesn't mean I'm right every time, but, at least I do attempt to base my argument in well-researched data and facts. So first up, GDP. GDP, very simple calculation. GDP is made up of taking consumption, which is just consumer spending, plus investment, plus government spending, plus exports, minus imports, okay? And what we saw in the first quarter were the imports were much stronger. And then in the second quarters, I'm going to show you that they were much weaker. And that makes sense, right? Because at the, right at the end of March and April, the talk of tariffs was really going strong and striking a lot of fear. So in the first quarter, there were a ton of imports coming in, way more than usual, because everybody was trying to get ahead of the tariffs. And then in Q2, we didn't see as many imports, which makes sense because everybody already imported everything. So we're not going to really see how everything is playing out totally until we get the Q3 GDP report. That's going to be a very interesting report, but let's take a look at these. So this is the Q1 report, and you may recall it came in at, it actually went down by 0.5%. And now with this measurement of the GDP, this is how this chart needs to be read. So if it's above this zero line, it adds to GDP, and if it's below this line, it takes away from GDP. And all of these are positive readings. So the more consumer spending, the more investment, the more government spending, the more exports, the better it is for GDP. But imports, the more imports there are, the worse it is for GDP. So that's why even though there were more imports in the first quarter, you see it here as a negative reading. That makes sense. Now here is the Q2 report. Consumer spending up, some investment down. Really no government spending or exports to mention, but since imports were at a really significant low, that contributed a lot to GDP. So that's how that number was calculated. Now I'm going to be very interested to see the Q3 report because there's all these trade deals. I'm sure you've heard. There's been Japan, the EU, there's the UK, trade deals with the Philippines and Cambodia and Vietnam, and all of those trade deals also involve significant investments into the country. And as you can see, investment is a very important part of GDP, but those haven't happened yet. Those are future promises. It's going to take for some time for those to trickle in. So future GDP reports will be very interesting because now the tariffs will have plenty of time to season, and the the investment will start coming in, and we'll be able to monitor whether or not there's a lot of government spending, which I'm sure there won't be because that is one of the missions of the administration. And exports will be a very important part of things too, because remember that one of the goals of the administration has been to open up foreign markets to our domestic producers. And so as we start exporting more, that too will contribute greatly to GDP. It's very hard to get an accurate reading of what's going on right now in the economy, 100%, because so much has happened so quickly. But as we get into Q3 and then Q4 and then into next year, all of these things will have had time to really season. And I think that we'll see some very interesting reports. And from an analysis of the data and also the intent of what they're trying to accomplish with these tariffs, the data does lend to a positive outlook for these things, but I'm going to get more into that in just a minute. So finally, U.S. consumer sentiment, that's some good news. Consumer sentiment is up the past 2 months. Now, it's way down from normals, but at least it's more positive. I wouldn't say that people are exactly positive yet, but it's nice to see that people are starting to feel a little bit more positive about things in general. So remember that. Keep that in mind as you're having your conversations with your prospects and your clients, because I'm not saying that we want to turn a blind eye and ignore the negative, but we do want to focus on the facts and data, which is all that I can, deal with and trade in. So far, the facts and the data do lend themselves to having a cautiously optimistic outlook on the economy. So I want to talk about the news and what you hear, because you, like me, I'm sure, encounter everyday clients that have a lot of anxiety, a lot of concerns. I feel like I'm either a bartender or a hairdresser and also a psychiatrist, because I spend half of my day talking to clients, even clients that are under contract and made the decision, going back and rethinking and rehashing their decision. And so that's why I present this information to you, because it's important to be a counterbalance to what they're hearing on the news. So you may recall back at the beginning of April when the Q1 GDP report came out, it was just all these so-called financial experts got on these news programs and just pontificated about basically the world was ending. We're going to have a recession. One of them referred to us getting ready for an economic nuclear winter. Everybody was saying, well, that's the end of your 401k, because remember when he announced the tariffs, the stock market tanked, and well, that's it. That's the end of your 401k. Nobody's ever going to retire again because all your 401ks are gone. It was so dramatic and so over the top. And what bugged me about it is that they didn't present any analysis. They just said it. And so if you're saying things off of feelings rather than based off of data, then you're not doing a service to your listeners, because you're not presenting facts. Everybody should do their best to present objective facts and data, and then give an analysis based off of the objective facts and data. Facts and data are facts and data. They're not open for interpretation. They are what they are. But what you think might happen because of the facts and data is a subjective experience, and different people will see them different ways, and that's fine. They're entitled to do it. But at least present a rational thesis for the argument that you're making, not just, well, I just feel like it's just going to tank the economy. So in the end of Q1 GDP, when that report came out in April, it was the end of the world. And the reason was, well, tariffs. See, this is proof. Tariffs are going to destroy the economy, even though the tariffs hadn't taken effect yet. Then, as we got into April, and then in May, and then in June, and then in July, all of these inflation reports came out showing that inflation was not being impacted by the tariffs, even though the tariffs were in effect. And then the narrative was, well, the tariffs just haven't been impactful yet. So I don't know how you square that circle, how you can, before the tariffs take effect, say the reason for the Q1 GDP is because of tariffs, and then after the tariffs are in effect and the effects of tariffs are not showing up in inflation, say that we just haven't seen the effect yet. This doesn't make sense. Now, I'm not saying that we're not going to see any impact on inflation from tariffs. I think we probably will, some. But what I'm saying is we're not going to see this Armageddon-style total apocalyptic impact on the economy that we've been told that we were going to receive, or experience, I should say. So it's very important to be mindful of that. And I want to just give you some things to think about as you're having discussions with people, especially those, because it seems like every day I'm talking about tariffs. So I'm going to talk to you about that with you, and we will see why tariffs are, in my opinion, most likely not going to have a significant impact on inflation. So, first of all, we know that exporters are absorbing the cost of tariffs. So these exporters, these other countries, want access to our markets. So in order to continue to have access to our markets, they are reducing their prices so that the importers can pay the tariffs. The importers are also absorbing the cost of the tariffs because, look, when COVID hit, so many of these companies started making record-breaking profit margins, some as much as 45%. They have a lot of room to give, okay? And so what seems to be happening is that not all the exporters are reducing their costs to cover all the tariffs, and the importers are not reducing their profit margins to cover all the costs of the tariffs. It's mostly a combination of the two. So the exporters are giving some, the importers are giving some, and a little bit is being passed on to the end consumer. But the impact is minimal due to dilution, and I'm going to talk to you about that right now. Let me move myself out of the way. So this chart goes back about 15 years, and most notably over the last 10, you'll see that imports as a percentage of GDP ranges somewhere between 13 and 15%. That means that of all the products and goods and services that we consume in the United States, okay, only between 13 and 15% are from imported goods and services, okay? So mathematically, it is impossible to have catastrophic inflation on the whole economy when only 13 to 15% of the goods and services that are being consumed are imported. That is just a mathematical impossibility. That's number one. So no matter how you slice it, you cannot get to the point that the tariffs are going to cause catastrophic and far-reaching inflation, because it's only 13 to 15% of the total products and services that we consume in the United States. But let's just say, even if 100% of the cost of tariffs was being passed on to the consumer, the person buying the end product, okay? Even if that were true, it still would not have a catastrophic impact on inflation. And here's why. Because first of all, tariffs are not inflationary. They are a one-time price increase. And it's just a one-time price increase. If it's 15%, it's 15%, and then it's built in, and that's that, okay? Inflation is persistent, and it grows. And it's caused by external factors, like at the end of 9/11 when we printed tons of money, or at the end of COVID when we printed or during COVID when we printed tons of money, and we infused all this cash into the economy, but the availability of goods and services didn't change, right? Basic supply and demand. If you have a whole lot of demand, which was created by increasing the monetary supply, and you only have a fixed number of goods and services, which is where we even had shortages, well, then the cost of the goods and services are going to go up, and in those cases, they went up quite dramatically. So inflation affects everything, okay? Tariffs are affecting 13 to 15% of some things, and therefore it cannot have far-reaching inflationary impact, because it's limited to to only up to 15% of the products. So the other thing is that, remember, like if you're importing a car from Japan, well, yeah, you're going to pay a tariff on the whole car. But there is a lot of things that are being manufactured in the United States that are built from many different parts and pieces, okay? And sometimes, a product, let's say, for example, is 25% built from parts and pieces that are imported from another country. Well, only the 25% of the product that is imported is going to be subject to tariffs. So let's take, for example, you have a widget, the widget's $100, 25% of the widget is built from imported parts and pieces. So that 25% of that product that's built from imported parts and pieces is subject to tariffs. Well, that means that the widget isn't going to increase by $15, right? Okay, 15, because the tariffs are 15% and our widget's $100. So it's not going to go up by $15. No, it's going to go up by $3.75, because that's 25% of the overall product that is being built from imported parts and pieces. And that is in this imaginary scenario where 100% of the cost of tariffs are being passed on to consumers, and we know they're not. So in sum, my rationale why tariffs are not going to have far-reaching inflationary implications are: number one, exporters and importers are by and large absorbing the cost of the tariffs. Number two, inflation impacts all goods and services universally. It doesn't affect a small segment or type of product or a small percentage of products. It affects everything. Number three, the small amount of tariffs that are being passed off to consumers, because it only comprises 13 to 15% of all the things that are consumed, are not going to have far-reaching implications. And because a lot of the things that are being consumed are only partially made up of things that are imported to assemble the final product. So that's it for me. I just wanted to share that with you because as you are talking to people and they're experiencing their anxiety and worried about the future of the economy, we can't know for certain what's going to happen, and tariffs may yet prove to be significantly inflationary. I doubt it, but I'm not going to say it can't happen. But so far, based off of the data that we've had, and we don't have a lot because it hasn't been going on very long, but at least so far, the data suggests that there is reason to be cautiously optimistic that tariffs are not going to have a catastrophic effect on inflation and thus the economy, and that there is reason to be, as I said, cautiously optimistic about the economic future. That's it for me. If you have any questions, please don't hesitate to reach out anytime. I'm always happy to take your call and take your deep dive. Remember, all of these slides that I use in the videos are available either in the video, the email that you received, or in the links on YouTube. And if you could please like the video, share the video, subscribe to the channel if you can. That would be a huge help. Thank you so much for watching, and have a wonderful day.